Basics of stock market.
I would need some help.
Thanks God you're here, Pekka. Stock market. It's a very complicated topic today. Will you give me a hand, Pekka? Whatever. Hope you will help me. Yes, thank you. Hello, beautiful people. It's Tatiana Ivleva from Pipo Living and Pekka today for you. Today we are talking about stock market. We'll try to make it as simple as possible for you to start investing right away. But remember, we are not your financial advisors. No. So think thoroughly and research extensively before you give up your money. Okay, we need some courage today. Let's go! So, what is a stock market? No. Yeah. Before we dive into stock market and investing, you need to remember that you need to have your emergency fund full. What's an emergency fund? It's your savings that cover 3 to 6 months of living expenses. And these are the separate amount of money that you can't invest. This is for emergencies only. So if you want to invest, you need to have that down. If you need more information, I have video here and in the description as well. You can find the link. So have your emergency fund and then we are starting. So back to the stock market. The stock market is a place where individuals and institutions buy and sell stocks of different companies. The prices of the stocks are determined by the demand and supply for these individual stocks. Stock exchanges are marketplaces for the individual stock transactions. The exchanges are seated all over the world. The most popular ones are the New York Stock Exchange, Shanghai Stock Exchange, London Stock Exchange, the Nasdaq Stock Exchange, Amsterdam, Tokyo, Hong Kong, and the list just goes on and on. And we have some good news for you. Maybe the news are not that fresh, but in order to have transactions on any stock exchange, you don't need to literally go there anymore, like walk. You can just trade online. Yeah, not that fresh news, but anyways, it's a good thing to know. So now, onto stocks. A stock represents a share of a company that you can own. That's that easy. Imagine there is a company, let's say Pipo and Friends. That's Pipo Living. So Pipo and Friends. That's a good company. It has good products and it's developing. And at some point, the management decides that they need some additional capital. They want to grow, they want to go to additional markets, they want to expand. So they need additional capital. And one of the ways that they can acquire additional capital is that they issue stocks. So they make the IPO, initial public offering. So they now have their stocks issued on the stock exchange and you can purchase them. Let's say they have 100,000 shares. So if you buy one share, you own 100,000th of the value of these Pipo and Friends. How do you determine the value of the company? You take the number of shares, that's Q here, the price of the share, that's P here, multiply them, and that's the amount the company is valued right now. Easy. What's not so easy is determining the fair value of the company, where the company is under or overvalued or it's fairly valued. Not an easy task, but that's the one that helps you determine where the company is good to invest in or not. Investors are seeking the companies that are undervalued. So they think that with time, the value of the company will grow and the prices of the stocks of this company will grow as well and they'll become richer, more rich. So this is investment in a nutshell. Giving up money now, expecting to receive more later. Dividends are another reason that people invest into stocks. Imagine Our imaginary company, Pipo in France, earns substantial amount of money. It's doing good, it has great revenues and profits, and you have purchased their shares. Wouldn't it be logical and fair if they share some of the revenues, some of the profits that they have with you? That's exactly what they do if they pay dividends. They can pay you, for example, once a quarter, and the money will be sent directly to you. Doesn't it sound great? It's just the problem is the dividends are not that high actually. For example, Johnson & Johnson company, do you know that they produce shampoo and all that jazz? The stock price is now around $144, and the amount they've just recently paid was $404. So that's 2.7 per share, not that much. But if you remember the magic of the compound interest, you reinvest those dividends and reinvest them again when you get them again. And with this magic, you'll see your money grow and much faster, and you'll benefit from it much more than if you've just taken it and bought a coffee in Starbucks. Index funds. Do you know what's an index fund? Okay, I know that. A stock index is basically a collection of stocks of different companies that you can own without purchasing the individual stocks. Did you understand? So it's kind of a collection. These collections are based on different characteristics of the company. These characteristics can be the size of the company, the industry the company operates in, or the country, and some other characteristics. So for example, the S&P 500 index, Standard & Poor's 500, that's the 500 biggest companies in the US economy. And you know what? I googled that their market capitalization is almost 80% of the whole economy. 80%, can you imagine that? I googled it. And some of the largest companies of the S&P 500 is what? Microsoft, Apple, Amazon, Facebook, and Alphabet. Alphabet is Google. They even have the sticker GOOGL because no one knows Alphabet. Of course, investors know. If you want to reduce your risk of investment, but you still want to invest into the stock market, then S&P 500 is your go-to. You diminish your risk by investing in it because it already includes companies that are well established, that won't probably disappear even in 5 years, maybe even more, who knows? Anyways, their business is good and established and everyone buys their products. So you need to buy them, the index. And also the risk diminishes the fact that there is a 500 of them in the index. So if one or two or maybe even more companies don't perform that well and their stock prices are decreasing, they have the other 499 to help grow the index. And they will probably do, because look at the chart. Should be somewhere here. It was calculated that historically S&P 500 grows 8% a year. That's more than inflation, at least in dollar and eurozone, and definitely more than you can get keeping your money in a bank. So there are lots of different indexes apart from S&P 500. There's Dow Jones Industrial Average, Nasdaq Composite, and lots of others. So dig into, find the one you like and invest in it. How to pick a stock? It's hot here, that's a hot topic. Okay. I'll just tell the top of the iceberg because people spend years trying to find the right way to value the stock and to decide what to buy. Okay, if you're a seasoned investor or you have high risk tolerance, or maybe you just found a perfect candidate to invest in, we can go for purchasing individual stocks. Picking the right stock can be definitely a challenge. But what do investors usually do? They have an extensive research over the stocks. So, in a nutshell, there are two basic ways of research. the qualitative and the quantitative method. Qualitative is the one that is text-based. It is based on a smaller number of companies and it is in depth, while quantitative is number-based. It is based on a large number of companies and it is not all that much in depth. So investors usually combine those methods and give valuations of companies. But there is also one more thing: social media. All that news and tweets. Did you see that tweet that Elon Musk said about Tesla shares? He said that they don't worth all that much, and what happened? The shares dropped. Not that much, but they did. They've recovered, of course, but they did drop because of some social media tweet. We have a great tip, me and Pekka, for you. You can just start small. You don't need a huge amount of money to start. With time, your money will grow. Do you remember I was talking about the magic of the compound interest? I'm not the only one that have noticed this magic. Einstein said, compound interest is the eighth wonder of the world. The who understands it, earns it. The who doesn't, pays it. Do you want to be the one who earns or the one who pays? I think the answer is obvious. So how exactly do you buy a stock? You need to find brokerage when you open a brokerage account and you're good to go. You can buy stocks. Where do you find it? The easiest way, I think, is just to go to your bank, ask them if they have a brokerage. Usually they do. The other way is to Google brokerages that operate in your country. I think this way is better because you can find much better rates there. That's what I personally did. The downside of this kind of brokerages is that you can only buy a whole share and the prices are sometimes not that small. For example, the Tesla share is now around $900. Maybe you don't have it just now, the 900 to purchase the stock, but you want to start investing. We have an answer for you. There is another type of brokerages where you can buy small fractions of shares. Isn't that cool? In most cases, you don't even have to pay fees when buying shares in those type of brokerages. But please read carefully about their fees, they still have them. The biggest fee that I encountered when using it was when withdrawing money from my account, and that was 25 euros, I guess. But please pay attention to that. The brokerage I used for that purpose was eToro. They have really friendly interface, really easy to use, and they have a cool customer service. So if you're interested, the link is in the description or you can Google yourself. Takeaways of the investing in stock market for beginners. Is it risky? Yes. Is it rewarding? Potentially yes. But remember, you lose only when you sell. Thank you for listening up to the end. It was a very long one. Please write in the comments, did you like Pekka? He's so knowledgeable. Thank you for joining us today. If you want to see more videos on my channel, please like, subscribe, hit the bell button. I will see you next Friday. See you, love you, bye. Mwah.